Hello, people listening to this. I'm just going to tell you a little bit about the history of inflation, current inflation, and what you can do to protect your money against inflation. So, to start it all off, in 1792, the Congress passed the Coin Act of 1792, and that established the dollar as the country's standard unit of currency, and along with that, created the United States Mint, which produced and circulated money. The dollar since then has lost over 97% of its value, and a dollar back in 1792 would be worth the same as $30 today. This is a pretty big problem because as you get older, the hard money that you saved up 30 years ago would be worth significantly less. $4,800 30 years ago would be worth the same as $10,000 today. So basically your money would have lost half of its value since 30 years ago. The Fed now has been trying to keep an inflation rate of around 1 to 2% per year for the last few decades. But in 2022, we had an 8.5% inflation rate over just the last 12 months. This was caused by a number of issues, including the pandemic, bottleneck supply chains, and energy and food markets worsened by the war against Ukraine by Russia. The March inflation numbers were the first to capture the full surge in gas prices after Russia's invasion of Ukraine, and the Federal Reserve will be forced to raise interest rates aggressively in the coming months to try to slow borrowing and spending in an effort to try and lower inflation. Many economists believe that inflation is going to stay above 2% a year ratio for the next about decade to come, as wages are being lowered compared to last year due to inflation really not keeping up with the wages at 8.5% and unemployment being so low. Mr. Goodhart, an influential economist who predicted this recent spike in inflation, believes that inflation will maintain a level of 3 to 4% for the next decade to come. He says that as labor becomes more scarce, workers will push for higher wages in turn for driving up prices. This is scary because our money would be losing over double a year than it used to, making it even harder for jobs to keep up with rising wages. Alright, now that I've talked about inflation as a whole, I'd like to talk about ways that you're actually able to counteract inflation through different assets. My personal favorite way to protect my money from inflation is by investing in the stock market. If you solely want to protect your money from inflation and minimize risk, you'd be better off investing in an ETF. An ETF stands for a exchange traded fund, and basically what that means is it's a collection of safer stocks all into one fund that you can invest in. An example of an ETF would be the S&P 500, which contains 500 different stocks from different asset classes, so you can buy this ETF and own a small part in 500 different companies. If you want to have the opportunity to outperform ETFs and inflation, I would personally invest my money in individual stocks. The downside to individual stock picking is that there's a lot more risk and a lot more to understand what you're investing in. One of the best ways to know how risky a stock is to look at its market cap. A market cap is the number of shares in the stock times its stock price. So basically it's the total amount of money that a company is worth. When a market cap is higher than 100 billion, that means that the stock is safer and it's held by many people, and the company is usually very well established. A market cap below about 2 billion usually means that the company is newer and only one person can hold a large amount of control in that stock, resulting in that price of that stock becoming more volatile. However, smaller stocks have the most potential out of any stock because they can grow faster and have a higher total addressable market, as there's not a lot of people that use their products. A total addressable market, by the way, is how many people they can actually sell their product to, and since they're a lot smaller, they have a lot more people that they're actually able to address and introduce their product to. So this means that they would be able to grow a lot faster, having a chance of actually becoming a big market cap stock and a well-known brand if the company's actually able to execute, which in turn would drive the stock price up exponentially. Another way to look at a value of a stock is to look at its PE ratio. A PE ratio stands for the price to earnings ratio, and basically what that means is the price of a stock versus how much money it earns. The S&P 500 currently sits at a PE ratio of about 24, which means the average market cap of the 500 largest stocks in that fund is equal to about 24 times those companies' earnings. An example of a stock with a low PE ratio is Toyota, currently with a PE ratio of 8. One reason for this is that their debt is $126 billion, which is almost 30% more than last year. And another reason is that people aren't trying to invest in the future and have been switching to electric cars, and Toyota has been doing that very slowly. An example of a high PE ratio stock in the same industry would be Tesla. They currently have a PE ratio of 209, and people have been debating for years if Tesla should be worth that much with such a low current profit. A reason why this stock is so richly valued is because their potential for future earnings, as they have a lot of market share to steal in the car industry and also the autonomous driving sector, as they are the number one player in that sector and also the electric vehicle sector. Another asset class I would recommend investing in, if you tolerate risk, is cryptocurrency. This asset, in my opinion, has the most opportunity to expand as a whole in the next couple decades, but I would not really recommend it at all if you don't like the risk and you'd rather just protect your money from inflation like we were talking about before, as 50% crashes in cryptocurrencies aren't really out of the ordinary. The first cryptocurrency that comes to everyone's mind is Bitcoin, and I would also argue that's one of the best cryptocurrencies to invest in. It was the first one ever, which makes it unique as it's trying to become the better version of a global currency. It has a high liquidity, low fees, and is accessible to everyone around the world. El Salvador recently was the first to officially adopt Bitcoin as a legal tender, which is a great milestone for Bitcoin and crypto as a whole. Personally, I only invest in one cryptocurrency, which makes it even riskier because the market cap is under $500 million. The cryptocurrency I'm talking about is VGX, and it's a native coin to the Voyager platform. What Voyager is, it's a cryptocurrency brokerage that lets you buy and sell over 60 different coins and has a loyalty program on VGX, their native coin, where you get 7% interest a year just for holding VGX along with other benefits. The main catalyst for Voyager and VGX at the moment is their debit card that's being released right now, where you get 9% interest on the money that you would hold on that debit card, and it spends anywhere that accepts MasterCard. In the future, Voyager looks to become a bank, where they do anything and everything that a bank does, integrated with cryptocurrency, and they would still have their native crypto token as VGX. The main problem with VGX is that it's extremely volatile since it's worth 2,000 times less than Bitcoin, and the price can fluctuate greatly. I would not recommend this to anybody that's not able to tolerate risk, and definitely not someone that's going to need that money in the next year. The best way to tolerate these drops is to buy more when it goes down, and by having confidence in what you're investing in, by doing your own independent research. Okay, thank you for listening to me ramble on about boring finance stuff, and the point I'm trying to drive home is don't let inflation eat your money and invest it somewhere according to your risk level.